Hey, Alex here again, and now we're on accounting for merchandising businesses. So chapter 6. This is a very, very good chapter. It's a pretty big chapter because there's a lot of journal entries involved in this one because you have to come at the perspective of the buyer and the seller, and both have corresponding journal entries that go along with them. So let's start with the intro. So, when you are low on cash but need to pick up party supplies, housewares, or other consumer items, where do you go? Many shoppers are turning to Dollar Tree stores. So the dollar stores, the nation's largest single price point dollar retailer with over 3,400 stores in 48 states. So, for the fixed price of $1 on merchandise in its store, Dollar Tree has worked hard providing new treasures every week for the entire family. Pretty neat. Despite the fact that items cost only $1, the accounting for a merchandiser like Dollar Tree is more complex than a service company. So merchandisers have a little bit more entries involved compared to service businesses. And so this is because a service company sells only services. They don't have inventory. So a service company doesn't have inventory. With Dollar Tree locations and merchandise, the company must design its accounting systems to not only record the receipt of goods for resale, but also to keep track of what merchandise is available for sale, as well as where the merchandise is located. In addition, Dollar Tree must record the sales and cost of goods sold for each of its stores. Finally, Dollar Tree must record such data as delivery costs, merchandise discounts, and merchandise returns. This chapter focuses on the accounting principles and concepts for a merchandising business. In doing so, the basic differences between merchandiser and service company activities are highlighted. The financial statements of merchandising and accounting for merchandising transactions are also described. Okay, so basically, when service businesses have fees earned, so they provide a service, and then that's revenue. And so basically, I provide you a service, you pay me the money, and then I get the money, and there's no exchange of goods or items. It's just you pay for service, and I deliver service. But with the merchandiser business, first we buy goods from a vendor for resale to a consumer. So it's like we're a middleman. We're buying the goods to resell. And so we have to keep track of inventory and the cost of the inventory to us. And so we're going to have a new account. We have a cost of goods sold, which is cost of goods sold is the price we paid. So when we buy something, we're going to put it on the books at the price we paid, and then when we sell it, we're going to take it off the books at the price we paid. So if I bought a box of crayons and I bought them for 50 cents and then I sold them for $1, what happened is there's initial entry of me debiting merchandise inventory 50 cents, me crediting cash, or accounts payable. And then what happens when I sell it, I'm going to, for $1, let's say I sell it for $1, so I get to debit cash, credit sales, and there's another entry. There's, when you are selling, there's always going to be more entries than if you're buying. So then when I sell, I'm also going to record. I'm going to debit cost of merchandise sold for 50 cents, and then I'm going to credit merchandise inventory, because now I'm taking the merchandise off the books and expensing it while also claiming the revenue and gaining the cash or the receivable. So you see there's two things going on. And the difference between an income statement for a merchandiser versus a servicer, a business, is a service business is going to have the fees earned, and it's going to have minus any expenses. So it's pretty basic. But a merchandiser is going to have sales less any sales returns and allowances, less any sales discounts, and then you're going to less that from cost of merchandise sold to get the gross profit. So sales minus cost of merchandise equals gross profit. And then we're going to list off all your expenses, operating expenses. The first one being selling. You always do selling expenses. Selling expenses are any costs associated with the selling of the goods. So advertising, sales salary, delivery, any delivery, if depreciation on any store equipment, so that's the physical store. So basically anything involved in the selling of the item is going under selling. And then we have administrative expenses, which are all your office people. So you have office salaries expense, rent expense, depreciation of office equipment, insurance, office supplies. So all the parts that aren't involved in the selling, but more in the administrative office people. Then you total those operating expenses up, which you'll subtract from the gross profit to get to the income from operations. See, this is a multiple step income statement we're on now. So now we're breaking up the income statement to show exactly what's going on, what cost us more, what cost us less. And then after we have income from operations, we're going to have other income and expenses. So here's where we're going to list our rent revenue, interest revenue, our rent expense, interest expense, rent expense. So we're going to list everything that's not part of the business exactly, but just other sources of income or expense that happens or that we do on the side. And then we're going to have net income. So that's the multiple step income statement. Sales minus any returns and allowances equals net sales. Net sales minus cost of merchandise sold equals gross profit. Gross profit minus operating expenses equals income from operations. And then income from operations minus other income and expenses equals net income. So there's two sets of ways to keep track of cost of merchandise. There's the periodic inventory system and the perpetual. 95% of businesses use perpetual, and so that's the main one that's most important. But periodic mom and pop stores will still use that, so it's good to know that too. Basically, under the perpetual system, each purchase and sale of merchandise is recorded in the inventory and the cost of the merchandise sold account. So every time you sell something, you're going to record the cost. Under a periodic, you're not going to do that. You're only going to wait to the end of the period to find out how much the cost of goods sold was. So I see that's a little bit, you don't know exactly how much you have at any point in time under the periodic, but you do under the perpetual. So the good thing about the perpetual, I'm going to show you some perpetual transactions. So let's say we have a cash sale. So we sold merchandise for $1,800. So we debit cash for $1,800. We credit sales for $1,800. But we also have to put in another entry because we're selling. So we have to, the cost to us was $1,200. So we're going to debit cost of merchandise sold, credit merchandise inventory. And now when you do QuickBooks or what have you, it'll automatically behind the scenes do that for you. And it uses the, we're going to get into inventory costing next, but under QuickBooks it uses average costing. So you just mix all your inventory up and average the cost at it over all of them. So you're just going to, but usually it's whatever the cost it was to you is what you're going to record. If you make a sale, if a customer buys with a credit card or a Visa, sometimes there's processing fees that are charged by clearinghouses. So any processing fees charged by the clearinghouse or issuing bank, they're always going to be recorded as an expense. So you're going to debit credit card expense for, let's say, $48, and you're going to credit cash. And it's basically just an expense. You're just saying, oh, I got to pay my merchant fees for being able to use cards. Very important. You don't want to lose a sale because you can't accept card. That's ridiculous. Okay, and a sale on account is the exact same as a cash sale, except instead of debiting cash, you're going to debit a receivable that you'll collect later. And so but you're still going to have the cost of merchandise sold account. Okay, sales discounts. This can be kind of tricky for some people. When you have a term on it, like term 210, comma N30, it means you have a maximum of 30 days to pay it, the N30. But if you pay within 10 days, you get 2% off your total purchase, which is good. It rewards people for paying early. So if you think about it, it's going to benefit you to pay it a little bit early. So the entry will basically, if you pay within the 10 days and your purchase price was $1,500 on a receivable, on an account, this is if you had an account and you have a certain amount of time to pay it, you would credit your accounts receivable for the full amount, the full $1,500 that you purchased the merchandise for. You would debit cash for $1,470, the actual discount price, and then that $30 discount that you had for paying early, the 2% off the $1,500, is going to be debited to sales discounts, because sales discounts is going to lower the cost, the amount of cash you're getting. So this is if you were selling to somebody. If someone bought on account, if someone bought your goods on account and now they paid for your goods, you gave them it can go either way if you're buying or selling. But let's say if you're selling and they paid within your discount period, they saved a little bit of money. They saved $30 for paying early. That's a sales discount. Sales returns and allowances is if they actually return the goods. So you're just going to debit, let's say they returned goods worth $225. You're going to debit sales returns and allowances for $225, and you're going to credit their receivable, because now they don't owe you anymore for that merchandise. So you're going to take it off, but you're going to not debit sales. You're going to debit the contra sales account, which is sales returns and allowances, which will reduce the amount of sales account on the income statement. But the goods also had a cost to them that we previously recorded for $140. So we're going to debit merchandise inventory for $140, and we're going to credit cost of merchandise sold for $140. So whenever something's returned to us, we put the stuff back on the shelf in the books as well. So, oh, okay, well, I'm sorry you didn't want that. Here, we'll take it back. So we're going to put the merchandise back in the books, and we're going to take the cost out, because now that we didn't sell it, it didn't cost us any to sell it. So that's why there's always two entries for selling or getting merchandise back as a seller. Now, when we purchase stuff under perpetual, we're just going to debit the merchandise inventory for the whole amount, so $2,510, whatever it cost us, and we're going to credit cash. Now, if we paid on account, we're going to credit a payable, not cash. And purchase discounts also. So purchase discounts, if we pay the vendor within the period, it's just like if a customer paid us within the period, we get a discount. Except there's no discount account. Any discount is going to be credited to the merchandise itself. So when we pay that account off, let's say we have a 2% discount off $3,000. When we pay our $3,000 bill, we're going to only pay $2,940 cash, and then $60 is going to be in the merchandise inventory to make up. See that because we paid less, the merchandise costs less to us. So we're not going to record any special account. We're just going to take it out of the merchandise account. Say, oh, our merchandise is lower. So it's a little bit simpler. There's no separate account. Okay. FOB shipping. There's a little rhyme I have for this. FOB shipping, buyer takes a clipping. That means the buyer pays the shipping. FOB destination, buyer takes vacation. So FOB destination, seller pays shipping. So FOB shipping point, buyer pays. FOB destination, seller pays. Remember that. FOB shipping, buyer takes a clipping. FOB destination, buyer takes vacation. Remember, FOB shipping, buyer doesn't pay. FOB shipping, buyer pays. FOB destination, seller pays. And basically, under the perpetual, any cost of shipping is going to be added to the merchandise inventory. So if shipping was $50, debit merchandise inventory for $50, credit cash for $50. When you purchase it, when you sell it, if you're selling merchandise, you're going to just debit the delivery expense account for the $50, and you're going to credit the cash for the $50. So if you're purchasing, you're going to add the cost of the freight to the goods. If you're selling, you're going to have a separate account to track that. Okay, sales tax. Sales tax, when you collect sales tax, you're going to, let's say they bought stuff and it's $106 altogether. So you're going to put it, let's say and it's a receivable. So you're going to put it all into accounts receivable, Lemon Company, for example, 106. And then on the credit, you're going to have sales for 100 and then sales tax payable for $6. Because that $6 we can't claim as revenue. We don't get to keep that. But we're going to keep it as a liability so that we know how much we owe the local authority or governing body, how much we owe the state, and then we'll send that money to them at the end of the period. So we're just holding it. But if we're only holding money, it's a liability. Trade discounts are just when a business gives a business another discount, and you don't record any special entry for that. You just take the trade at the trade. There's no special. Okay, shrinkage. Inventory shrinkage can be caused by theft, spoilage, breaking something. Shrinkage, what you'll do is you'll physically count the inventory at the end of the period. Whatever is missing from the book versus the physical. So whatever the difference between your account and the books and the physical is going to be shrinkage. And the easy way, it's an adjusted entry. The easy way to do this is you debit the cost of merchandise sold. So let's say our shrinkage was $1,800. Debit cost of merchandise sold for $1,800, and then credit merchandise inventory for $1,800. So we're just recording the shrinkage as though it was a sale or the cost to us, which it is. So when inventory shrinks, we're going to expense it out, take it off the shelves in the books, and debit it the cost. It's going to raise our cost of goods. That's why you need proper controls over inventory. You don't want your employees to just have a full reign. You want to make sure it's under lock and key, if you can help it. Closing entries are the same. You debit each temporary account with the credit balance, such as sales, and you credit each temporary account with the debit balance, such as expense accounts. A new ratio of net sales to assets. So this shows how effective a business is using its assets to generate sales. So you're going to take net sales for the period divided by the average total assets. The average total assets is the beginning of the year's assets plus the end of the year's assets divided by 2. And you do that because you find the average, because at some point it wasn't the same, it wasn't the amount at the beginning, at the end, it's somewhere in the middle. So you want to get a good middle ground. So divide total sales by average, divide net assets, net sales, divide net sales by average total assets will give you the ratio of net sales to assets to see how well you're turning over your assets to generate sales. So it's good to have, the higher the ratio, the better. A high ratio indicates an effective use of assets. So if you have a ratio of 2.43, that means for every $2.43 in sales, you turned over, for every dollar in assets, you made $2.43 in sales. So it's like you're doing pretty good. Your ratio is good leverage. So it's good if you can increase that. That's what that means. So if your ratio is 0.50, not very good. It means for every 50 cents in sales, you still have $1 in assets. You're not really matching. You're not really turning over your goods. Okay, and the periodic system, we haven't done that yet. The periodic is almost like a perpetual, except when you buy merchandise, you're not going to debit merchandise inventory anymore, credit payable or cash. You're going to debit purchases. And the reason you do this is because at the end of the period, you won't know your cost of goods until you take beginning inventory plus purchases minus any purchases, returns, and allowances or purchase discounts, add in any freight, and then minus the ending inventory. By doing this, you get the cost of goods sold, and you know how to put it on, and then you'll know what to put on the income statement. So remember, under the periodic, you take your beginning inventory plus your purchases minus any returns and allowances, purchase returns and allowances, minus any purchase discounts, gives you the net purchases, add in the freight, and then that'll give you a cost of merchandise purchased, and then you have the merchandise available for sale when you add your beginning plus all your purchases and freight. Then you always minus your ending inventory for the month, which will give you your cost of merchandise sold, so you can back into the merchandise sold. So under periodic, you're backing into the cost of goods, whereas in perpetual, you always will know, because you'll always be having an entry to keep it up to date. And so that's the biggest differences between these two ways of doing things. So here's an example. Purchase 30,000 of merchandise on account. Under the periodic, you debit purchases for 30,000, credit accounts payable. Under the perpetual system, you debit merchandise inventory for 30,000, credit accounts payable for 30,000. See the difference? How you're actually keeping track of merchandise under perpetual, but under periodic, you're just dealing with the purchases account, and you'll figure the merchandise out at the end. It's pretty neat. So you don't keep track of any cost of goods or merchandise under periodic, only under perpetual. And that's why also under let me see, under when you pay, if you pay within the discount period under periodic, that discount isn't gonna go under merchandise inventory. You're not gonna credit merchandise inventory for the $50 discount. You're gonna credit purchases discounts. So you're gonna actually have to keep track of that discount separately. You're not gonna mix it into the inventory. You're gonna just keep it separate. So this chapter is pretty good. It's a lot to know because there's two separate ways of doing things, and if you're under periodic or perpetual. But if you have any questions, feel free to leave a comment, and maybe I can help answer anything. But that's the basics. I'll probably do a example video later for each chapter that needs examples. But so far, that was about it. So I hope this helps. So thank you, and I'll see you for chapter 7, inventories.